Today, we're diving into 6 growth stocks with significant upside potential, most of which are trading near their 52-week lows. Hello and welcome back to Fire Stocks. Please subscribe to our channel, like this video, and leave a comment. It'll motivate us to make more videos every single day. The first stock on our list is Advanced Micro Devices, AMD, a major semiconductor company. Over the past year, AMD has dropped a staggering 51%, and year-to-date, it's down nearly 20%. However, over the last decade, it has massively outperformed the S&P 500, surging 3,383%. Currently, it's trading close to its 52-week low, with both Wall Street and Seeking Alpha labeling it a buy. It's also looking fairly attractive in terms of forward valuation, sitting in the 20-21x range. Looking at AMD's latest earnings, more than half of its total revenue comes from the data center segment, which grew 69% year over year. Additionally, nearly all other income streams have seen double-digit growth, leading to a total revenue increase of 24%. Margins have also improved, with gross margin increasing by 3 percentage points and operating margin rising by 6%, a key metric compared to the sector median. As a growth company, AMD is expected to continue its upward trajectory, with double-digit earnings per share, EPS, growth projected for the next 4 quarters. Over the past year, the company has consistently met or slightly exceeded EPS expectations, maintaining a 100% track record. If AMD achieves its 2025 EPS estimate of $4.70, it would be trading at a forward price-to-earnings ratio of around 20-21x. This represents a 5% discount compared to the broader sector median of 21.6x and a 51% discount relative to its 5-year historical average. AMD's revenue growth is also outpacing the sector, with a 14% year-over-year increase and a projected 19% growth over the next 12 months. In contrast, the sector average remains in the mid-single digits. Over the past 5 years, AMD has expanded its revenue at an annualized rate of 34%, compared to the sector's 26%. Meanwhile, EPS is expected to grow by 43%, significantly outpacing both the sector average of 15% and AMD's 5-year average of 33%. Examining profitability, AMD's gross margin stands at 53%, surpassing both the sector median of 50% and its 5-year average of 48%. Its bottom-line profit margin sits at 6.4%, which, while above the sector median of 4%, is slightly below its 5-year average of 11.4%. One key indicator of financial strength is AMD's rising cash flow from operations, which now stands at $3 billion, well above its 5-year average of $2.3 billion and significantly higher than the sector median of $108 million. Now let's look at intrinsic value. Using a discounted cash flow DCF model, we calculate AMD's intrinsic price at $137. This is based on its historical free cash flow growth, which has fluctuated between negative and positive over the years. Moving forward, we've used a conservative 25% growth estimate. However, different scenarios yield different results. At the higher end, a 30% growth rate suggests a valuation of $190, indicating a potential 98% upside. Meanwhile, a more conservative 20% growth rate places AMD's value near its current share price, implying that the market is already pricing in long-term free cash flow growth at that level. As always, we apply a 10% margin of safety, meaning a buy-up-to price of 123 years. However, with the stock currently trading at 96, that translates to a 30% margin of safety. Wall Street analysts are very bullish, with a consensus price target of $148 over the next year, implying a 54% upside. Let us know your thoughts. Do you see AMD as a buy, hold, or sell? Now let's move on to the next one, which is ASML. ASML is down 29% over the past year and 2% year-to-date. However, over the last decade, it has massively outperformed the S&P 500, rising 533%. Currently trading near its 52-week low, it holds a double buy rating from Seeking Alpha and Wall Street. The company also offers a dividend yield of around 8% and trades at a forward PE ratio of 34. ASML has a strong competitive advantage, manufacturing critical semiconductor equipment. Its net sales are up 28% year over year, with solid margins, operating profit increasing by 3 percentage points and net income by 1. Beyond revenue growth, margin efficiency continues to improve. The company expects growth in 3 of the next 4 quarters, though cyclicality in the semiconductor industry could bring some downturns. It has a 100% track record and anticipates $25 in EPS, leading to a forward PE of 27.3. On valuation, ASML receives an F because it trades at a premium to the sector, currently 27% higher. However, compared to its own 5-year average, it's trading at a 32% discount. Regardless of the metric used, ASML is expensive relative to the sector, but undervalued compared to its historical levels. Growth is rated C+. Year-over-year revenue growth is 3%, with forward expectations around 10%, close to the sector's mid-single-digit rate. Over the past 5 years, ASML has grown faster at 20% and 16%. EPS is projected to outperform the sector at 19.4% versus 14.6%, though slightly below its own 5-year average of 22.4%. Profitability is strong, earning an A+ rating. Gross margin stands at 51.3%, slightly above the sector's 50% and its 5-year average of 50.3%. Net margin is 27%, well above the sector and close to its historical levels. Cash from operations is near $12 billion, significantly higher than its 5-year average of $7.6 billion and well above the sector's $108 million. Our intrinsic valuation estimates ASML at just over $1,000 based on a discounted cash flow model with assumed growth rates of 12%, 6%, and 14%, leading to a $1,055 valuation. This suggests a strong margin of safety, with the current price offering a 35% discount. Wall Street values ASML at $940 over the next year, implying a 37% upside. Even under a lower growth assumption of 12%, the stock still presents a 25% margin of safety, reinforcing its long-term potential. The next stock I want to focus on is New Holdings. New Holdings has dropped around 10% over the past year and remains flat year-to-date, currently trading near its 52-week low. It holds a double buy rating from both Seeking Alpha and Wall Street, with a forward PE ratio of approximately 19. Breaking down its revenue, the company has 3 key income streams: credit cards, which have grown 8% year-over-year, lending, the fastest-growing segment at 55%, and other revenue up 28%. Customer growth is also impressive, rising 22% over the past year, while deposits have surged by 55%. Total revenue has increased by 24%, and bottom-line efficiency has improved by 3 percentage points. Looking ahead, the company expects double-digit growth in EPS over the next 4 quarters, maintaining a 100% track record. With earnings per share projected at 53 cents, the stock currently trades at a PE ratio of 19 to 20. On valuation, New Holdings receives a C rating. The sector trades at a higher multiple, meaning investors are paying a premium, 103% on a trailing 12-month basis and 80% forward-looking. However, other valuation metrics like price to sales, price to book, and price to cash flow also indicate a premium. Despite this, its growth remains strong, earning an A rating. Year-over-year revenue is up 49%, with a forward projection of 34%, while the sector lags in the mid-single digits. Over the past 5 years, revenue has expanded at an even faster pace, 103% and 61% respectively. EBIT and EPS growth also significantly outperform the sector, justifying its A and A+ ratings. Profitability is solid, receiving a B+ rating. The company's net income margin stands at 36%, well above the sector's 23% and significantly higher than its own 5-year average of 3%. Cash flow from operations has reached $2.4 billion, a sharp contrast to its 5-year average of $22 million and the sector's $147 million. Our valuation places the stock at 15.20 cents, indicating a substantial margin of safety. At the lower end, the margin extends to $10.64. Wall Street analysts remain bullish, with a consensus price target of $16.33 over the next 12 months, suggesting a 57% upside. The next one I want to focus on is Hims & Hers Health, with a ticker symbol of IMS. It is up 144% over the last year and 46% year-to-date. It is currently trading in the mid to lower range of its 52-week span, with just 1 buy rating from Seeking Alpha. However, Quant is close to upgrading it, needing only a 3.5-point increase to flip into a buy. In the latest quarter, online revenue surged 98% year-over-year. Subscribers grew 45%, and the average monthly online revenue per subscriber increased 38%. The company anticipates growth in 3 of the next 4 quarters, maintaining a 100% historical track record. It currently trades at a forward valuation of 54.3, significantly above the sector average. The company holds a devaluation rating with a 123% premium on a trailing 12-month basis and a 115% premium forward-looking, which is consistent across all valuation metrics. Growth remains impressive, as expected for a high-premium stock. Revenue is up 70% year over year, well above the sector's 7%, though slightly below its 5-year average of 82%. Forward revenue growth is projected at 45%, also far exceeding the sector's 7%, though lower than its 5-year average of 55%. EBITDA growth is particularly strong at 97% compared to the sector's 7%. Free cash flow growth is even more substantial at 168%, with the sector lagging at 13.6%. Profitability earns an A rating. Gross margin stands at 80%, above the sector's 59% and its own 5-year average of 78%. The company's bottom line sits at 8.5%, outperforming the sector, which is burning through cash at 4%. Over the past 5 years, when Hims & Hers was also operating at a loss, cash burn was at 15%. The company now generates significant cash from operations at $251 million, far surpassing its 5-year average of $24 million, while the sector continues to burn through $14 million. Our valuation places Hims & Hers at $44. Using a lower 15% growth rate, a margin of safety exists up to $37. Wall Street estimates a price target of $46 over the next year, signaling a 28% upside. However, those who believe in a more moderate growth rate would see a much larger margin of safety. At current prices, this suggests at least a 40% upside. The next one is Chipotle Mexican Grill, which is one of my favorites. It is down 5% over the past year and 16% year to date. However, over the last 5 years, it has massively outperformed the S&P 500, rising 291%. Currently trading near its 52-week low, it holds a double buy rating from Wall Street and Quant. The bulk of its earnings come from in-restaurant business, but both in-store and digital sales are growing at double-digit rates. Revenue is up 15% year over year, with operating and net profit margins improving by 1 percentage point. The company has a 100% track record of EPS growth and expects continued expansion over the next 4 quarters. Chipotle trades at a valuation of 38.5 times earnings, significantly above the sector's 15, marking a 151% premium. However, compared to its 5-year average, it is trading at a 41% discount. Growth is rated B+. Year-over-year revenue growth stands at 15%, with forward projections at 13.3%, well above the sector's low single-digit rate and close to its 5-year average of 15%. EPS is expected to grow 20%, outpacing the sector's 11.1%, though slightly below its 5-year average of 24.4%. Profitability earns an A rating. Gross margin is 41%, above the sector's 38%, and in line with its 5-year average. Net margin is 14%, significantly above the sector's 4% and its own 5-year average of 9.5%. Chipotle is not only increasing revenue but also improving margins. Cash from operations stands at $2.1 billion, nearly double its 5-year average of $1.3 billion, and well above the sector's $284 million. Our valuation estimates Chipotle at $70, based on a 20% projected growth rate. If growth were adjusted to 15%, the stock would still be pricing in that rate of free cash flow expansion. Those assuming a 20% growth rate would see a strong margin of safety. At this price, Chipotle offers at least 25% upside, reaching $52. And at a 30% margin of safety, it would be valued around $49. Wall Street sets its price target at $67 over the next year, implying a 34% upside. The next one I want to focus on is Robinhood, which is up 118% over the last year but remains flat year to date. It is currently trading in the mid to lower range of its 52-week span, with just 1 buy rating from Wall Street. In its most recent earnings, the company saw significant growth across multiple revenue streams. Crypto revenue surged 733%, with options revenue also rising sharply. Overall, total revenue increased 115% year over year. The company expects growth in 3 of the next 4 quarters, backed by a 75% historical track record. It is currently trading at a forward PE of 24.9, well above the sector average of 10.4, reflecting a 108% premium, something reinforced across all valuation metrics. Growth receives a B rating, with year-over-year revenue up 58%, significantly higher than the sector's mid-single-digit range and above its 5-year average of 52%. Forward revenue growth is projected at 30%, also exceeding both the sector's 6% and its own 5-year average of 15%. Adjusted EBIT increased 167% year-over-year to $1.43 billion, compared to $536 million in 2023. Profitability earns a B rating. Trailing 12-month gross profit stands at 91.1%, outperforming the sector's 59% and its own 5-year average of 76%. The bottom line sits at 48%, well above the sector's 23%, and far better than its 5-year average of -81% when it was burning cash. However, the company is still not generating positive cash from operations, reporting $57 million. While the sector's average is low at $147 million, it remains positive. Robinhood's 5-year average is $27 million, showing a smaller but still negative figure. Valuing this company is challenging, but Wall Street remains highly bullish. Analysts project a price target of $71 over the next year, indicating a potential 92% upside, nearly double its current price. Let us know your thoughts on these 7 growth stocks. Do you see them as a buy, hold, or sell? And what's your current strategy in the market? Have a great day, and we'll see you in the next one.